Good evening, everyone. My name is David Sung, and on behalf of all of us at Nicola Wealth Management, I'd like to welcome all of you, clients and guests, and thank you very much for joining us here this evening. So we're here tonight to talk about one thing, and that's real estate. So let's jump right in. Throughout history, some of the world's most successful and well-known families have built significant wealth by owning and investing in real estate. Now, I know that most of you here are probably familiar with the Kennedy family, one of the world's most famous U.S. political families. They're an extremely wealthy family, and they built a significant amount, or a good portion of their wealth, Joe Kennedy built in the 1930s and 40s by making investments in headline-making business enterprises such as banking, liquor importation, and insider trading, which actually was legal at the time. Now, what some of you may not know is that the vast majority of their wealth was made through investing in real estate, with the centerpiece of their family's real estate empire being struck by a deal Joe Kennedy made in 1945 with the purchase of the Merchandise Mart in Chicago for just under $13 million. Now, at the time, it was the world's largest financial structure with just over 4 million square feet of floor space, and the Kennedy family sold this building in 1998 for just over $600 million. So for generations, this proved to be the family's financial foundation for many, many years. Now, I know, at least for me, when I think about the Kennedy brothers, perhaps the Chicago Merchandise Mart is not the first image of real estate that comes to mind when I think about them. Maybe this is a little bit more fitting. Now, this particular slide here, for those that are clients, I know and we've shared this with you a number of times over the past 5 years. What you're looking at is the average, the asset allocation of the average retail balanced mutual fund here in Canada. And what's noticeable is the absence of any exposure to hard asset commercial real estate. Now, the equity markets have been on a bit of a tear for the past 2 years. And given the increase in the public equity markets, this has brought their 5-year average annualized rate of return to just over 5%. So how does that compare? Well, in our view, having exposure to hard asset commercial real estate and a good diversification of that in any high net worth investor's portfolio is important, but that's certainly not just our view. We've also shared this chart with you a number of times, and what you're looking at is the asset allocation of 3 of Canada's largest pension plans. You can see that they're certainly far more diversified, and they have exposure to hard asset real estate. Their rates of return over the past 10 years, the same time frame, are anywhere from 7% to 9%, or 2.2 to 4.5% greater than the average retail mutual fund. So 2.2% may not sound like a significant difference, but let me put it another way. In 2003, if you had invested $1 million in the average retail mutual fund, that would be worth about $1.6 million by the end of 2012. Now, if you were able to put that same $1 million in the Canada Pension Plan, by the end of 2012, you'd have $2 million, or over $400,000 more, which is a 25% difference in capital, and I think we'd all agree that's a significant amount of money. So, the Canadian pension plans, they've had a great track record. Real estate's an important part of their asset allocation, and I think they're considered by many to be some of the world's best performing pension plans, and recently the Ontario Teachers' Pension Plan was ranked by The Economist as the #1 performing pension plan in the world out of 300 pension plans. So when you're doing your holiday shopping at Pacific Centre Shopping Mall here downtown this year, just remember that you're helping to support the Ontario teachers because they have ownership of the Ontario Teachers' Pension Plan. What you see here are some of the headlines to give you an idea as to where these pensions think the opportunities in real estate lie. I've taken a couple clippings on the Canada Pension Plan, and you can see they've invested $500 million into some U.S. commercial real estate recently, followed by taking a stake in 5 major U.S. shopping malls. So the pension plans feel that this is a good place to be. And when it comes to our asset allocation, we take a very similar approach. We believe in having a diversified asset mix with exposure to hard asset real estate and cash flowing assets. Our results, closely match what the pensions have performed at. And I think the big takeaway on this is it suggests that the vast majority of the return any of us earn as investors comes not because of any individual security selection we make, but because of our decision on asset allocation. Our speakers, Wayman Crosby. Wayman's the CEO of Nicola-Crosby, our real estate asset management group. And preceding Wayman will be John Nicola, the CEO of Nicola Wealth Management. So with that, John, I'm going to pass it over to you. You can kick off the formal comments for our presentation this evening.
Thank you, David.